A lot of people are already used to using Google Drive, so I think the switch to Zoom is going to affect us for a while. But along the line, I believe a lot of people are going to adapt to it because I think it'll be best like this for everyone to be able to benefit from it. I mean, in as much as it hurts my feelings that we don't have the audience that we used to in here, that hopefully you guys would understand that it's for the better of everyone, so that everyone can be able to benefit from it. And also for those who don't attend, they can be able to like go through the Zoom and, um, watch the video, right? So today we are going to talk about um, reinforcing liquidity concept and price delivery, right? Now, what does that even mean, reinforcing liquidity? We have, for those who now we're going to take this range, this high and this low, because that is the current range that the market just created recently. I don't want us to go and be talking about past data because anyone can literally analyze past data very, very easily. So I think I would like us to do this instead and analyze the current data that we have, which is this is the current high and this is the current low, right? Now, when we talk about external range liquidity, we're talking about the current trading range which is the current trading range will have both buy side liquidity above the range or the high. Now, this is external range liquidity. The liquidity that resides above this area is external range liquidity because this is the range that we are trading in. This is the range high, this is the range low. Now, in between this range, there's both internal and external range liquidity, but in both. So the number one question that everyone asks themselves is, where is the market more liable to move at, right? But the second thing is the current trading range will have a sell side liquidity below the range or low, which is this is the sell side liquidity, right? Now run on liquidity, which means seek to pair orders with the pending order, right? Run on liquidity seeks to pair with the pending order liquidity pool. The external range liquidity runs can be low resistant or high resistant in nature. So for the market to be able to reach out for these external range liquidity that's residing over here, it can be either influenced by price and time or by market manipulation. Now, how do you know which is which, right? Because you need to be able to like what is going on, which one is going to reach out for the other. So then now we have the internal range liquidity. This is the internal range liquidity. This is the internal range liquidity as you see right here, right now. So internal range liquidity means there is liquidity residing in between this area that the market is literally trying to reach into that area, take out some highs and lows, take out some highs and low between the little time frame, because right now we're on the 30-minute time frame. But if you break this down, on the 5-minute time frame, you see that there are people trading this little fraction of the market right now. So I think this is actually internal range liquidity. So when current trading range is likely to remain, liquidity void will fill in that is gap to risk. And when the current trading range is likely to remain, fair value gap will be a risk. And afterwards, we have a market makers buy and sell model will form inside the range. So if we are waiting for external range liquidity to be taken out, I'll write this down so that you guys, this is external range. Okay, this is the external range liquidity here, right? And here also is still external range liquidity. Anything that happened outside this range is classified external range liquidity because that is where we have the high and the low. This is the range of the market right now, right? Now, what happens is anything that happened inside this range is internal range liquidity. So these price action took out these 30-minute high. That is, he has taken out the internal range liquidity from this market at this 30-minute high. Now, there's a huge possibility for it to sell for this a little low in these.
What did you say?
So there is a possibility for this market to reach out to this sell side liquidity on the 30-minute time frame, sitting just below this area. But before the market needs to reach that, what does the market need to do? Now, we have to keep in mind our overall directional bias while trading this lower time frame, because our overall directional bias is what is going to influence our decision and being and aligning ourselves towards the market in the right way. Now, before today's news outbreak, I called out a sell in USD JPY, but what happened is the market spiked first above because it was trying to reach out for external range liquidity that was sitting below this area, above this area, excuse me. So after taking out this external range liquidity, what happened is seeked out for these other external range liquidity that was residing below this area. And that's what mostly happened on Fridays because we get trapped. Now, in between this area, now you get trapped because you don't know where likely is the market more willing to go next. Now, there's a possibility for a bullish continuation because on an overall higher time frame, we see that the buy pressure has always been in control. Now we have, look at this rejection over here. It will reject it based off of what the bullish daily order block, right? Now, indirectly, it has created equal highs here. Now, for those who know about equal highs, you know that if this market has created equal highs here, what is it more liable to do? The market is more liable to reach out to those equal highs. These are the equal highs that the market created here on the daily time frame, right? Let's name it. Equal highs, right? Now, if this market has equal highs here, what do we know about equal highs? The market has a huge possibility to reach out to these equal highs. Now, if the market has a huge possibility to reach out of this equal high, where does it need to get its bullish momentum? It needs to get its bullish momentum from a previous daily or weekly order block, right? Now, if we go to the weekly time frame for us to have more bullish confirmation for our next week trading idea. This is like next week trading idea that I'm literally sharing with you guys right now on UJ. So if you're trading UJ, you should be looking for buy opportunities. Why? Now look at how today's weekly Friday's weekly candlestick closed and gulping last week weekly candlestick, because last week weekly candlestick was a little bearish. But today's close in market marks a bullishness of next week candlestick on UJ, meaning any currency pair that's invertedly correlated to UJ will suffer a bearish movement. So you should be looking for bearish movement, maybe on gold, on AUD, USD. So if this market closed today, any open in the market next week, and we see USD JPY sell into this weekly order block. Now see how the weekly order block will align itself with this daily order block. Now let's take our rectangle a little bit, right? Let's take our rectangle and box this weekly order block here and extend it to the right, right? Then we'll go now to our daily candlestick. You see that the weekly order block will align itself with the daily order block, giving us our second confirmation. Look at how it aligned itself to the tick here, right? Now, which means this market did a zigzag movement in this area to take out both buy side and sell side liquidity residing into the previous range that form an external and both external range liquidity. So the market reach out for those buy and sell side liquidity. So the external range liquidity as well, you can also name it, or you can also call it the buy sell side liquidity. So the market did a zigzag movement and took out both buyers and sellers in the market. Now, if you go to the 4-hour time frame, it gets a little confusing because look at what is happening. What is happening now is this: you get confused because you don't know where the market is going next. Next 4-hour candlestick bought above into a 4-hour bearish area. Now we don't know how this market will close. We'll have 2 hours to go. So if this market has to close in 2 hours time, there's a huge possibility that if the market sells and it doesn't close bullishly, closing the weekly candlestick bullish, then we should probably change our directional bias. But then if it closes like this, there's a huge possibility for us to see a bullish movement in this market coming next week. So what do we need to do? You are not obliged to be in this market right now. Now, this zigzag movement on the 4-hour time frame, if you go on the daily time frame, you see now that this zigzag movement is a little confusing more than ever. So knowing us now, knowing fully well that we've done a top-down analysis and we'll have the overall directional bias of the market in the nearest future, we know that this little movement in the market is just to bring sellers in the market so that we will be buying their stops. So any sell like the market is trying to sell now should be, or we should look at it like institutional trader as a buy opportunity for us. And look at this rectangle that we placed here, right? This rectangle, it aligns itself with the weekly order block and the daily order block. That's why you had this nice rejection when the market dipped into this area. The market rejected instantaneously because it has already taken out the sell side liquidity that was residing over here and activate sell stop that was sitting over here. So what did it need to do? It needed to buy back to their stops, right? Now, after buying back to their stop, it found a lot of resistance breaking day for our order block that resides somewhere around here, right? So now you get caught up in the market. Now this is a typical Friday trap day movement that literally happens in the market every single time. That's why sometimes it's not advisable for people or for you new traders to trade on Friday, because Fridays are trap days. And trap days sometimes you get very confusing because you might make and lose money because you don't really know. Even if you are buying or selling this market, there's a huge possibility that you made money and you lose money today if you held on to this trade. Because look at what happened, the zigzag movement of like what? 30, 45 p above. So if you were selling this market, you should be able to like maybe your stop loss should have been like 50 p for you not to get hit. And look at where we were. This was the current market price before the sudden volatility, which means even if your stop loss, even if you were using a 50 pip stop loss, it would have taken you out. If you say you enter here, your 50 pip stop loss should have been somewhere around here. So even if you're using a 50 pip stop loss, you'd have gotten hit before the market sold into your direction. Even if you are buying the market and you are using still a 50 pip stop loss, you will still get hit. So today's trading day was just a trap day in the market, and these days happen. You will not say you have 100% win trade every single time, but these things happen because this is just the market doing its thing. These are days that you would think that maybe you are good in trading, and some days you just get wrecked up like this. So you need to accept that. But now, knowing fully well our overall directional bias, we know that the market has more buy power than sell power. So what we will be doing, we'll look for any sell opportunity into this area. Will be the market looking for bullish momentum on maybe a lower time frame or the block. So we move from the 30-minute, from the 1 hour, we'll go to the 30-minute. And if we move from the 1 hour to the 30-minute, you see that we have some nice areas over here that the market can find support from to gain more bullish momentum. Now let's go to the 15-minute more. Now you see how I did my top-down analysis from the weekly to we are now on the 15-minute to the 15-minute. Now, this is the 15-minute bullish order block. So if this market drop into this 15-minute order block, that will be our buy signal for us to buy this market to this external range liquidity. Because if the market is buying back, it needs to reach out to this external range liquidity that is at the same time or has at the same time created equal high. So if you're looking for a buy in this market, this should be your first target, right? Your second target now will go on the weekly time frame for you to be able to see your second target. Your second target now should be this fair value gap that the market has created when it was selling here. So ever since the market hasn't or price hasn't reached back to this area, so there's a huge possibility that price might reach into this area before any aggressive sell. Because I believe UDO is going to collapse aggressively, but not as easy as we think it will. We need to do some kind of market manipulation movement before that. So the market can literally come into this area to price this fair value gap that he has created, or you can just keep selling from where it is right now to seek out this liquidity right here and this area, right? So, and also this low, because he has already taken out this high here. So if he wants to reach for more liquidity, the area where there is more liquidity residing will be this low. So we should be very observant of the market and see what the market has to do within this period, and also trade very, very cautiously without taking too much risk. Now, reinforcing the order block theory, right? We have a bullish order block. So what is a bullish order block? A lot of people ask me that question. What is a bullish order block? What is a bullish order block, right? A bullish order block is the lowest candle or price bar with a down close that has the most range between open to close, and it's nearer a support level, right? Now, this is what the definition of a bullish order block. Listen to the definition. A bullish order block is the lowest candle, which is this lowest candle, or price bar with a down close that has the most range between open and close. The most range between this open of this candle and this close of this candle. And nearer to a support area. This is a support area that the market has. This is another definition of a bullish order block. This is another definition of a bullish order block. So in the layman term, right, a bullish order block is just the last candle before the bullish movement from that support area or from that support area. This is a bullish order block. This is a bullish order block here. This is another bullish block. Any last candle before the next bullish engulfing candlestick becomes automatically a bullish order block. Now, bullish order blocks are more respected on the higher time frame because on the higher time frame, they have more bullish momentum than on the lower time frame, right? So what validates, I know the next question that you guys would like to ask is, what validates a bullish order block? What makes you think that when you see a bullish order block, you should execute? Well, when the high of the lowest candle closed, the candle or price bar is traded through by a later form candle or price. That is the validity. What does the validity mean? After this close, the next candle that close, which is a bullish candle, it should close. That is when the high of this candle is the lowest down close. The price bar is traded through, which is the next candle is traded through by the later form candle or price bar. If you have just this bearish candlestick and the next bullish candlestick doesn't buy and close above it, this bullish order block is not validated. So what do I mean by that? For instance, here, right? Here, after this bearish candlestick, this next bullish candlestick did not close above these bearish candlesticks. So this was not an order block until the next candle, 1 hour candle came and closed above that form now, that validated this last bearish candlestick as an order block. So these actually is a valid order block because the next candle traded above it. These also is a valid order block because the next candlestick traded above it. These also is an order block because the next bullish candlestick traded above it. So for a valid order block, it needs to be traded above the previous bearish order block for it to form a valid bullish order block. So what will be, I know the next question that you would like to know is, what is your entry technique, right? Like, what is the entry technique that you need to use on or trading order block? So when price trades higher away, so this is a typical example, right? When price trades, let me take an example that's really from this, or this is another block, right? Let me take a valid one so that you can see how active it is. When price trade higher away from the bullish order block and then returns to test the bullish order block bar high, this is actually bullish. So what does that mean? This was the last candlestick before this bullish movement. Now, this was not the order block. This was not the order block because it didn't trade through this previous bearish order block. This was not the order block because it didn't trade through this previous bearish order block. But this last bullish candlestick validates this bearish candlestick as a bullish order block. So now what is your entry? After, like you say, when the price is traded, when price trades higher away from the bullish order block, and then it returned to the bullish order block. So after it trades like this, what happened? It had to return to this bullish order block to gain more bullish momentum. That is your entry. And if you're trading bullish order block, when you're entering here, when you're entering a trade here, your stop loss should be below the recent low that the bullish order block had created. That is where your stop loss wants to be, right? So let me take another example. This was the last order block on a 1 hour time frame. This was another block because the last bullish candlestick engulfed the last previous. These two can be considered as one bearish candlestick because this it's like a dodge, it's like a dot. So this became another block. Now after traded above, right? This has already validated this is another block. And a return in price into this other block is your buy opportunity. Now observe how ever since the market returned here, it bought back aggressively to the top. Now when it's buying, what is your setup, right? Your setup is the low of the bullish order block is the location of the relatively safe area for you to be able to put your stop loss, which is this low or maximum this low. That is too much even. But you can put it here for volatility's sake, for the market to have the room to do volatility, to fluctuate from one places to another. So you can feel free to put it somewhere around here. But normally, if this is the bullish zone, your stop loss should be around here. Now your exit position should be recent highs where we'll have fair value gaps, where we'll have buy side liquidity because you're heading for buy side liquidity, and where we'll have a bearish order blockers. That's where the market can find some hard resistance breaking that area. So since the market bought here, what happened? This was the recent high. That is where your first take profit is supposed to be, and your second take profit was supposed to be at the second high. Those were the high that the market was reaching out for the liquidity. Now observe what happened. Immediately after the market reached out to this external range liquidity that we were just from explaining here, at this time, this becomes the range that the market is trading at because that is the recent range. The same as we're doing our calculation on this range because it is the recent range that the market is trading at. So at this time, the market is reaching out to this high because that is the current external range liquidity that the market needs to reach out to. Now look at immediately the market sip into that area. Look at how the market collapsed aggressively. Now, if you had put your take profit here and you were risking what? You enter this trade here with this return that validated your order block. And now the good thing is I am recording this and I'll be able to drop it on our Telegram channel even when we are done, compared to if we're using Google Meet. So if you like calculate this, you take this and you calculate what you're risking, what? 9 pips for what? 9 pip for 60 pip profit. That is like a 1:6 risk to reward parameters. It's a good return. So you just risk what? 9 pip. Now look at how immediately the market slipped into this bullish order block. It even traded below. It just boom, bought above that area. So an assignment for you guys is go into your chart, observe order block, jot out your order blocks, try and backtest order blocks for yourself. But why backtesting order block? Keep in mind this. Why backtesting bullish order block? Keep in mind this. The bullish order block on the lower time frame are only valid from the higher time frame perspective. And what does that mean? For a 1 hour bullish order block to be valid, you also need to know that our overall higher for a 1 hour time frame bullish order block to be valid, we should have a weekly bullish order overall directional bias for us to see if a 1 hour order block is valid. Because if our overall directional bias is bearish on a higher time frame, there's a huge possibility that the bullish order blocks will fail, because the lows of the bullish order block will be where we'll be hunting the liquidity that will be sitting there. So, like I was saying, stop loss placement. So just below 50% of the order block, 50% of the order block told range is also considered to be a good location to raise the stop loss after price runs away from the bullish order block to reduce risk. So if you were entering this market here, immediately you see this market reject. If your stop loss were maybe somewhere around this area, you can move it back into your entry price in order to keep yourself safe. So that should, in case the market rejects and come back below, you get out at break even and you will not get hurt, you will not get burned. So that's also a good way to trade it. So liquidity, actually, when you understand this, you understand that you have a huge possibility to be making money trading just order block. And this is one of the multiple trading opportunities that you guys can be able to capitalize off of. Trading order blocks can literally give you the opportunity to be able to like make something for yourself. Now it depends. You need to have the overall directional bias in control, or the overall directional bias for you to be able to capitalize out of this. But now it's very easy, because every single thing that I'm teaching you guys about bullish order block is the same as bearish order block. You just need to reverse it. But like what I used to tell my student is, or what I always keep telling you is, a bullish order block, excuse me, what I used to tell my student is, and what I would share with you guys is this: look for what you're good at first. Submit to what you're good at first. If you are a good buyer, look for buy opportunities from the higher time frame and see how you can become very good at buying. And it will become very easy for you to look at sell opportunity, because you already have the overall buying perspective and buying trading strategy, that it will be easy for you to flip it and do the reverse to look for sell opportunity. If you think it'll be complicated for you to look at both buy and sell opportunity at the same time, so what you can do is, you first of all look for buy opportunities first. You first of all look for buy opportunity first, and then when you're good at looking at buy opportunities, then now you can start taking the same setup or the same strategy that you were using to look buy opportunity, to then flip it and do the reverse to get your sell signal. It is very easy, but then you need to take it one step at a time. One step at a time. Because if you want to be buying and selling at the same time, it will confuse you, and you might end up losing more money than you should have in the first place than concentrating in trading one thing. So I don't know if anyone has any questions to ask. If you have any question to ask, please don't hesitate to ask your question, and I'll be pleased to answer your question. Okay, guys, I see that there's no questions, so I'm going to call it a day today. It's Friday, and now we're going to end this class today, and we will send this recording. So, okay, brother, you have a question? Please go ahead. Okay. Okay, mitigation block. Great. That is if only we don't get caught up with time. So I'm going to share the light on that as well, because I believe it's very important for us to talk about that. So all the block theory, we have base, liquidity base, we have mitigation block, right? Now, what are mitigation block? For instance, this is the current market rate, right? Before, it'll be a little bit complicated for you. I don't know if you already understand all of that, but listen keenly. The mitigation block actually here is this last bearish candlestick before this bullish movement. Now, this last bearish candlestick before this bullish candle was automatically a bull order block, a bullish order block. But now, since the market sold and violated this bullish order block and came back and seek sell side liquidity, building more sell momentum, this bullish order blocks becomes the mitigation block, because look at what happened. When price come back and sit into that area, price rejects automatically, which means the banks are mitigating their losses. So what the bank do is